Welcome to MK_investment_insights, your trusted source for proven investment strategies, financial growth insights, and timeless wealth building principles. Today, we begin a multi-part journey into the Law of Success by Napoleon Hill, a masterpiece first published in 1925. While nearly a century old, this work remains one of the most practical and powerful guides for building wealth, and when applied to investing, its principles can transform your portfolio and your financial life. Hill's philosophy was shaped after interviewing over 500 of the most successful people of his time. Names like Andrew Carnegie, Henry Ford, Thomas Edison, and John D. Rockefeller. The result was a set of universal laws that explain why certain people create extraordinary wealth, while others struggle their entire lives. In this first part, we will focus on the mindset and core principles that form the foundation of financial success. 1. The definite chief aim. Wealth begins not with money, but with clarity of purpose. Hill calls this the definite chief aim. You must know exactly what you want financially, and you must be able to put it into measurable terms. If your goal is to achieve financial independence, define the number. Is it $2 million in assets? Is it $8,000 in monthly passive income? Without a concrete target, your investing decisions will be scattered and your results will be inconsistent. Think of it this way. A portfolio without a goal is like a ship without a destination. It drifts, it reacts every wave, and it rarely arrives where you want it to. Your definite chief aim acts as your financial compass. 2. The mastermind. No great fortune is ever built in isolation. The mastermind is Hill's concept of aligning yourself with people whose experience, knowledge, and vision can help you grow. In investing, this could mean networking with other investors who specialize in areas you want to master, joining private investment groups where opportunities are shared early, seeking mentorship from people who have already achieved what you aim for. When you combine your knowledge with the knowledge of others, you multiply your potential for success. Information asymmetry is real. The right connections often give you access to deals, insights, and opportunities that the general public never sees. 3. Self-confidence. Successful investors trust their own judgment. This doesn't mean ignoring expert advice. It means developing the ability to make informed, independent decisions. In investing, self-confidence comes from preparation, conducting thorough research before buying any asset, understanding both the upside and the risk, creating an investment thesis, and having conviction to follow it. Without confidence, you will always second-guess your moves, sell too early, or fail to take advantage of high-potential opportunities. Markets reward those who act decisively on solid information. 4. The habit of saving. Hill believed saving was a cornerstone of wealth, and he was right. But in the modern era, saving alone is not enough. Inflation erodes cash, so savings must be deployed into investments that appreciate in value or generate income. Make it automatic. Set up recurring transfers from your primary account into your investment accounts, stocks, bonds, ETFs, real estate funds, or your own business ventures. Your capital is your workforce. Send it to work every single month without fail. 5. Initiative and leadership. Many people wait for the right moment to invest. In reality, waiting is often the most expensive decision you can make. Initiative means taking calculated action, not recklessly, but without procrastination. Leadership in investing means taking responsibility for your financial decisions. It means owning your wins and your losses and learning from both. You lead your portfolio, you lead your financial habits, and you lead your future. 6. Imagination. The best investors are visionaries. They see what others overlook. They recognize patterns, industries, and technologies before they become mainstream. This doesn't mean guessing. It means observing trends and imagining how they will shape the future. Think about the investors who recognized the potential of personal computers in the 80s, the internet in the 90s, renewable energy in the 2000s, or artificial intelligence today. Imagination in investing is not daydreaming. It's strategic foresight. 7. Enthusiasm. Finally, enthusiasm. Not blind excitement, but passionate persistence. Enthusiasm keeps you engaged through market volatility. It fuels the discipline to keep learning, to keep saving, and to keep investing, even when short-term results seem discouraging. Markets rise and fall. Strategies evolve. But your energy, your drive, and your belief in your financial vision will carry you through the cycles. These 7 principles, a definite chief aim, the mastermind, self-confidence, the habit of saving, initiative and leadership, imagination and enthusiasm, are the psychological foundation of every great fortune. Apply them, and you create the mental architecture that supports long-term financial growth. Ignore them, and even the best technical strategies will struggle to succeed. In the next episode of this series, we will explore the disciplines and decision-making processes that transform these principles into concrete, profitable investment actions. This is MK_investment_insights, where financial wisdom meets strategic investing. Remember, wealth is not a coincidence. It is a consequence of consistent, intelligent action.